Right now, India's modern stock market is a hyper-connected digital fortress, processing millions of complex trades in milliseconds. The National Stock Exchange dominates this volume, executing the vast majority of the country's massive equity transactions. But rewind to the early 1990s, and the Bombay Stock Exchange operated as an exclusive analog club. Traders shouted orders across physical pits, exchanging physical paper. At the time, strict regulations forced Indian banks to hold their capital in government bonds, completely legally walled off from investing directly in the stock market. Because these cash-rich banks were drowning in paperwork and disconnected from any computerized central ledger, a massive multi-billion-dollar blind spot existed right between the banking sector and the stock exchange. To move securities back and forth across this disconnected network, banks had to rely entirely on trusted individual brokers acting as manual middlemen. Enter Harshad Mehta. He was a dominant market broker who recognized the exact mechanical vulnerability inside this fragmented, paper-based system. By squeezing capital out of the banking network, Mehta successfully siphoned off roughly 5,000 crore rupees to artificially drive up prices on the Bombay Stock Exchange. Mehta orchestrated a systematic hack of India's analog financial infrastructure. He weaponized a loophole in how banks managed their daily trades, draining billions without anyone noticing. To meet their government reserve requirements, banks constantly bought and sold securities using a mechanism called a ready forward deal. Instead of moving physical bonds, banks issued bank receipts, paper IOUs promising delivery. Mehta colluded with corrupt officials to print fake receipts backed by zero securities. He handed these worthless IOUs to unsuspecting banks for cash, routing the funds into his accounts. Because the 1992 banking network operated entirely without a computerized central ledger, the large banks had absolutely no way to verify if the underlying bonds actually existed. Armed with massive reserves of unsecured bank cash, Mehta marched straight into the Bombay Stock Exchange. He aggressively purchased specific shares, artificially inflating their prices through sheer volume. The most extreme anomaly of this pumping strategy was the Associated Cement Companies, or ACC. Look at this chart tracing ACC's stock. Driven by Mehta's fraudulent capital, the price skyrocketed from 200 rupees a share up to 9,000 rupees in just 3 months. The scheme fractured in April 1992. Regulators and journalists noticed Mehta's disproportionately large investments, investigated the underlying transactions, and exposed the fake bank receipts to the public. Investors realized the market was propped up on worthless paper. They sold aggressively, triggering an immediate 40% crash. The fallout was catastrophic. Over 1,000 billion rupees in market capitalization evaporated, leaving the defrauded banks paralyzed, holding millions in completely useless debt. The Indian government recognized that punishing a rogue broker would not fix the underlying vulnerability. The root cause of the crash was the reliance on disconnected paper, requiring a fully transparent, computerized network. Their first major software patch was the formation of the National Stock Exchange in 1992. This new exchange was built to force a nationwide transition away from physical trading floors directly onto secure electronic screens. Simultaneously, subsidiary general ledgers were completely digitized. By tracking real asset holdings in real time across a centralized network, regulators permanently neutralized the fake bank receipt exploit. To oversee this new digital structure, the Securities and Exchange Board of India, or SEBI, was granted heavy statutory powers to act as the primary market watchdog. While the Bombay Stock Exchange eventually modernized and survived, the crisis-born National Stock Exchange captured the momentum, and it dominates India's national trading volume today. Harshad Mehta's 5,000 crore rupee scam inflicted severe financial pain, yet it acted as the ultimate systemic stress test, forcing India to construct the secure, world-class financial technology infrastructure it relies on right now.